Tonight, your money at work, and Wall Street has been on a wild ride of late. This is what it did here today, and this is since last Thursday. The 5-day outlook showing the low here just in 1 week, 30,700. It's gained almost 2,000 points in 1 week. Let's take it out 1 month, and you can see the tips and dips along the way, which is where you're supposed to buy and sell. If you added up all these ups and downs, the market has swung more than 3,500 points in just 2 weeks. Look at what it's done in just 1 year. Since the pandemic hit almost 1 year ago, the low was 18,500 points right there. And again, above 32,500, almost 1 year later, it's gained 14,000 points. That's a 73% increase. So with all of this volatility, how do you assess the risk versus reward of getting into a hot market? I spoke with a Tampa financial advisor who has worked for decades here in the Bay Area, helping local families plan their future. And he tells me what's happening right now should really be a lesson for all of us. Well, look at this Wall Street rebound on a Monday. And a big sell-off on Wall Street today, just 24 hours after one of the best days of the year. It goes up, it goes down, it goes sideways. Dow went up 400 plus points yesterday. Well, it went down. Every day I report on Wall Street's closing bell journey live on ABC Action News at 4. But this week, this month, this year, it would give even Gordon Gekko a headache.
And what do you make of this nearly 2,000-point surge in a week?
What we're seeing right now is kind of a shift internally.
I set up a Zoom meeting with wealth manager John Wax, CEO of Waller & Wax Advisors.
What do you tell somebody who's trying to figure it out, where to go and how to take all this in?
First of all, we're seeing a lot of volatility. There is a lot of speculation going on in the market, and there's a lot of optimism about taking on more risk. So money moving around based on headlines is what's causing a lot of these gyrations.
Some of that speculation is coming from a new kind of investor, younger, bolder, more willing to take on risk, more likely to buy in and sell out during one day with fast trading apps like Robinhood, and more prone to go onto sites like Reddit, where the stock rumors abound and drive up prices on companies like GameStop.
It's much like a game of musical chairs where the music just doesn't stop. And there's a complacency and an optimism that takes over with this assumption that I'll just get out before it comes apart. The problem is when you get in a situation like this, when the music eventually stops, there are no chairs.
Then there's the $1.9 trillion about to be pumped into the U.S. economy from the COVID-19 relief package. And a new survey from Deutsche Bank just revealed most young investors plan to spend almost half of their stimulus checks on stocks, fueling an already expanding bubble.
The young investor jumping into the market, is that creating more volatility or more opportunity for everyone, regardless of income?
So it's not a bad thing that people are getting into investing with money, or they're finding the market and participating. What is critical is, in the long run, the style and method being used, the strategy being used for investing.
And what is the strategy? Slow and steady wins the retirement race. Think more Buffett, less Gekko. If greed is good, patience is better.
It's important that investors understand there are times where it seems like it's really easy, and then there are times where it seems like it's really hard. And reality is a blend of both. But the best thing that people can do is remember an old saying from Warren Buffett. He says, be greedy when others are fearful and be fearful when others are greedy. And right now, there's a lot of greed out there. So we don't know when, but it would be a good idea to make sure your portfolio is spread around well.
All right, so bottom line on this one, if you are going to play the market and do your own investing, make sure you buy a mix of safer assets versus riskier stocks. The general rule of thumb is you want a 60-40 split, 60% stocks, 40% bonds, and that equals 100% balanced. Meanwhile, back to